Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what's going on today. You can follow me at Finance. You can join our community, finding-value.com. We dive deeper into all these topics, looking for potential investment opportunities. We try buying those opportunities when no one is looking. We use ratios, technical analysis, and market conditions, which is basically cycles, in order to develop and use and employ the strategies. We use all of that information to make educated guesses on where to invest. So let's dive in here. Let's take a look. We got Paul. Paul says this is a practical realization of higher demand, which is for natural gas, resulting in a bigger raw volume swing. It's not even that cold, and I think two of the three will breach 300 billion cubic feet in terms of weeks of drawdowns. When a cold January can draw down 1.5 trillion cubic feet, 4.5 trillion cubic feet isn't enough storage capacity. Praying for warmth won't work in terms of natural gas. And really what the debate is do we have enough inventory in terms of days of coverage for natural gas? And I don't hear a lot of people talk about this all that often. If it is inadequate, what you will see is you're going to see gigantic swings in the natural gas price. And what it's trying to do is it's trying to guide the production or supply and thread basically thread it through the needle, where price controls production on the upside and the downside. But if you've got a small inventory, you get gigantic swings to say, we need more production, we don't need production. We need more production, we don't need more production. And that is a fault of not having enough storage capacity. So I think there could be a crisis that eventually builds in natural gas because the days of coverage versus the demand is too low, where we get these gigantic spikes in both directions. And the supply, maybe they've got a 6 month plus lead time to really respond. And that's just not, our lead time is not short enough for the response. So what companies may or may not do is they kind of have to guess what the weather will be. And that's just a horrible situation to put the producers in, and also to put the market in, and the consumers of natural gas. We need to build way more inventory. We need more days of coverage. And they're talking about natural gas storage projections and how we're running these deficits here, just given somewhat cold weather. I know historically, some years ago, we have been way colder than what we have experienced in December and even January here. I think January is going to cool down, but we're not even that cold. If we get really cold, what is that going to do to the price, and what's it going to do to our inventory levels? This is from Kevin. Charlie Munger says that margin of safety concept boils down to getting more value than you're paying. It's high school algebra. And people who don't know how to use high school algebra should take up some other activity instead of investing. So if you don't know high school algebra, investing is going to be rough to understand the concept of margin of safety and buying more value. And what that means is that the price of the equity is below the value that you're getting when you buy it. And that is the smartest way to buy any sort of investment, is because you're getting a deal. You're not relying on growth to kind of pull you out of a bad purchase. The Wolf of All Street. So, UK judge throws out a case to recover 770 million Bitcoin from a landfill. A UK judge has dismissed IT engineer James Howell's case to recover a hard drive containing 8,000 Bitcoin worth 770 million from a Newport landfill. Howells accidentally discarded the drive in 2013. and has since faced consistent denials from the city council. My question is this: Bitcoin will eventually end? Won't it all end in lost accounts, dead people's accounts, and people who password or lost the cold storage or whatever it is that they're storing it in? Isn't that all going to end up like this? Because if you can't recover it, well, where's it all going to end up? If you lose a password, can you get it back? If someone dies, that's essentially losing the password. So, isn't that where all of it will eventually end up over a long period of time? Is in a bunch of dead people's accounts or in the landfills if it's been lost? Which say men are taller than women on average. Someone will respond, I know a woman who's taller than most men. So much trouble with statistical averages. And then this girl does exactly what he described in terms of, oh, I know this person. What I do in terms of strategies is actually using statistics. And I think some people struggle with statistics. And what I do is I look at a normally distributed curve. A normal distribution occurs with height, strength, weight, IQ, certain genetics, hand size, foot size. You can basically apply this to everything in life. And what you'll see is that the majority or almost everything is normally distributed. So what I do is I use statistics and I use the normal distribution curve against ratios. Ratios is pricing an asset versus an asset and then finding out what is cheap with respect to history. And then what you can do is you can plot it against its normal distribution curve of history. And if something is really, really cheap, you can buy it and just sit in it and wait for it to turn. You can also use technical analysis and you can also use market conditions or the cycles to aid with not only identifying what's cheap or should be cheap based off of the cycle, but you could also get an idea of when it could get more expensive, coming from a very cheap level to getting more and more expensive. If you're using statistics, what I am betting on, if you were to bet on height, and just to use this as an example or an analogy, what I'm doing is I'm waiting for the man to come who is 4 feet 11 inches. And then when that man comes who's 4 feet 11 inches, I'm taking a bet and saying that the next man that comes will be taller than 4 feet and 11 inches. The statistics are in my favor. Now, I don't know when the next man will come, and I don't necessarily know for sure that the next man will be taller than 4'11. But what I'm doing is I'm making the bet when someone is incredibly short for a man and saying, well, I'm going to bet that the next man is going to be taller than 4'11. But I just don't know when that next man will necessarily come. And then the next time I'm betting, let's say a person who is 7 feet tall comes, and it's a man who's 7 feet tall, and I say, you know what? I am willing to bet that the next man will be shorter than this man that's here who is 7 feet tall. And that's all I'm doing is I'm looking at the normal distribution. I'm taking bets that are on the outer edges, and then I start to make bets like, you know what? I'm betting that I've got a 7 foot man here, and I look at the cycles that are coming. The next group of people who are coming are from a normal group of a bus that's about to be unloaded, and I'm willing to bet that no one is taller than 7 feet on that bus. So I'm making a bet like that. I'm not making a bet that a basketball team is coming from a professional basketball team, and I've got a 6'5" guy and saying, well, I'm going to take a bet that no one's taller than 6'5". I don't make those bets. I just wait for the cycle, which is the correct group that I'm betting against, comes against someone who's on the outer edges of that normal distribution. It's the same thing with oil. When oil gets to the outer distribution, where it's so cheap against other assets, I start piling into it because historically, the statistics or odds are in my favor. And I don't know if people understand that because they're not very good with statistics. I'm, if you compare that with also not just the ratio and the normal distribution compared to history, if you take that a step further and you say, okay, well, what if I have positive technical signals in the equities, in the commodities? And what if I have positive technical signals in a whole variety of commodities that are also correlated with oil or whatever specific commodity I'm looking at? And I've got overvaluations in other asset classes which are coming out of favor. That's your highest probability of success. But that doesn't mean it will happen immediately. It just means that you're able to recognize the situation. You can recognize the value discrepancies, and then you have to hedge yourself with time for this to play out. That is what statistics will give you. Now, I've gone through many statistical analysis classes. I had statistics for engineers. I had linear, what was that? Not linear algebra, it's linear systems or whatever it was. I had quality control, which is basically all statistics. Um, there's a lot of things that I have applied throughout my years and learned in school that are all statistics based, like null alternative hypothesis, quality control charts, using things with 3 standard deviations plus or minus, controlling production runs, looking at the ability for a process to meet a certain, uh, we'll call it a certain tolerance level. So you're looking at, uh, well, God, I'm trying to remember the name of the. It's not null alternative hypothesis saying one is stronger than the other, and then we will look at the capacity and its ability to meet that tolerance. So I used to calculate all this stuff back in the day, and um, you can apply it to investing. It's all applicable. David Murray research has commenced. We believe that the commodity sector is now at the start of one of the biggest rallies in 56 years, with an expected peak 2025 to 2027, as recently explained. You might want to check that too. And I respect him. He's called, some of these bottoms here, and I think he's pretty much dead on. And what I look at agrees with his reasoning here. And time frames. The Money Cruncher, he says married couples can withdraw $126,700 from their brokerage and pay $0 in federal taxes in 2025 if you don't have any other income. This is because of the 30,000 standard deduction and the 96,700 of long-term capital gains taxed at 0%. This is equal to $165,000 pre-tax salary. Invest your money. And this is what I am actually setting up for myself in one of my taxable accounts. Now, I don't know if I'll hit this 126,700. I think I might go below that just because if I retire out in the future, I can yank money out of retirement accounts on top of my individual account kicking off dividends. But this is something to understand is the taxes. How are you being taxed? And what money should I put in what accounts? I've really been trying to hit up the tax sheltered accounts with whatever money I can. So I'm trying to hit pre-tax to reduce my taxable income. And then I also try to hit up as much money in Roth accounts. Um, Roth IRA, I think it's $7,000 max contribution. You can backdoor it if you make too much money. And then you can also do a Roth 401k contribution, even by maxing out your pre-tax. You can do your employee and employer. You can max those out within the limitations. And then you can put the rest up to, I think it's 70 or 71,000 this year, up to that amount in a Roth 401k if you can't do any more pre-tax. So I've been kind of doing that stuff, trying to put as much money in these Roth tax-free accounts, pay the taxes up front, and then because if I don't have another account, I'd rather put it in a Roth 401k than an individual account because I'd rather be able to take money out when I retire, tax-free, and have that option. Health savings accounts too. I also utilize those. This guy says, I think less than 5% of the population is capable of second order thinking. Um, that might be the case. I dealt with a lot of people at work. I am I'm very good at not just second order, but all um, basically tertiary outcomes of a decision. Like I'm really good at this. And a lot of people that I work with that were like, say, HR, uh, they were really good at just first order and that was it. And I was like, really, guys, you don't understand the ramifications of making this decision on how it impacts everyone in the group and myself. And it deals with maybe people who are unable, maybe they have intermittent FMLA, where people miss like a day or two a week because of some reason. And it would just completely screw you up if you're trying to run a manufacturing facility and you've got a couple people like this. It's like you got to contain them and put them in certain areas if your cycle times are really long. And they just couldn't understand it. And I was like, how can you not understand this? This is unbelievable. It's not even that hard to figure out. And they couldn't even understand that people of the same level had different abilities. So if someone was a level 3 and another person was a level 3, they couldn't understand that they had great differences in output. And I would give examples like, well, Michael Jordan is labeled a point guard, and his backup of his backup is labeled a point guard or a guard, and they're not the same. They're completely different. Their levels and capabilities and the value to the corporation or the value to Chicago Bulls is completely different. And they couldn't understand that. And I was sitting there like, I just gave you an example. You couldn't understand that example? Holy crap. So it makes me think that a lot of the population really struggles to figure things out and think for themselves, which gives us, if you can do that, it gives you a large advantage because you are thinking way ahead of everyone else. Most everyone else is going to just run into what is doing well. They just chase price performance. And then they're going to parrot meaning there, if someone says, this is good, they'll parrot, this is good. They'll just parrot whatever other people are saying. That's what all the Bitcoin people are, from what I understand. And when you listen to them, you're just like, you're just parroting some crap from Michael Saylor or from someone else. They have no original thoughts or views for themselves. They don't know why they're buying it. They just know that it's going up and that it's good because it's going up. But there's other things, in my opinion, that are underlying the design of the system that could blow up Bitcoin. And that might happen when price goes down for a period of time. And that deals with, I don't want to get too much into it, but it deals with the mining and the cost of mining and putting that cost of mining into the processing fees. Autism Capital says, Zuck, probably in 2025, Meta, as well as other companies, will have an AI that can effectively be a mid-level engineer that you have at your company that can write code. In the beginning, that will be very expensive to run. Then at some point, a lot of the code we have in our apps will be built by AI engineers instead of people engineers that will augment the people working on it. My view is that in the future, people will be so much more creative and freed up to do crazy things. And I wonder what kind of impact this will have on the margins of a lot of the companies that don't have to hire people. And there is obviously a negative because a lot of people aren't able to creatively think for themselves. They're kind of just linear thinkers that need to be plopped into a job and told what to do. And that's kind of your lower not necessarily lower IQ, but a lot of them are lower IQ that say, hey, just do this repeated task over and over. When robots start to do that, I'm not exactly sure what they're going to be able to do. It'd be probably a pretty humbling experience. But this will impact companies. And if AI is that good, if let's go out on the tertiary effects here. If AI is that good and they can replace engineers and they can replace people maybe building some of the products and they become a lot more efficient, the companies themselves. What you have as a company is you've got a layout where you've got inputs, the company in the middle, and then you've got outputs from the company. We call it a SIPOC, Supplier Input Process Output Customer. That's what they use in lean manufacturing. So when we look at this, what I think is going to occur is you're basically leaning out the company. That's that process in the middle of the SIPOC. It's the P. And what you're going to do is if you lean out all these companies at the same time, you're going to say, we need way more energy and we need way more commodities, which is the inputs for these companies. And what's going to happen is you're going to get an exponential move very quickly, I think, in energy consumption and in commodity consumption. So I think if AI is successful at doing this, we are going to need way more production of commodities and energy. And I don't know if it exists. I don't know if it exists. And then AI is going to have to figure out how can we make products with different elements on the periodic table than what we have available but short. And it's going to be crazy to figure out all this stuff. And I'm sure we're probably going to get into different carbon-based solutions, maybe carbon fiber, fiberglass, different material structures. Another thing that people aren't very good is they like to extrapolate out what we looking backwards, extrapolate out going forward. But if AI is as good as what some of these people say, there's a possibility that designs will change. And when you start to push the threshold of designs, you need exotic materials. So you're going to see a lot more platinum, palladium, Inconel, gold, those types of materials because they have high melting points and they're extremely resistant. AI will have to figure out to perhaps dope these materials together. And when you dope these materials together, you can get these super materials like titanium aluminum, where you can have a lightweight, let's say, turbine wheel that spools up real quickly. Borg Warner put that in some of their turbos. There's other things that you can do with doping materials together, nickels and precious metals or different types of precious metals together to get these materials that don't exist today that we can use in just ridiculous setups for designs. Obviously, it's not going to be cheap, but it can push the boundaries of design because your designs are basically limited by how strong materials are or machining the materials. You can do 3D printing where you don't have certain, you can put a cavity inside of something else. You can't do that with machining unless you make it in multiple halves or something like that. So there's a lot of things that are coming that people can't really think of. But everything that I think of requires energy. And even if it requires energy, it's going to require materials if you want a physical product. So it's going to be materials. I think all wealth is going to be stored in future energy consumption, which is like oil, natural gas, coal, or the commodities themselves. Because AI is going to say, give me as much as I can get. And I think we'll have constraints on that side. Wolf of Wall Street says, I'm not sure there's a great financial argument for owning your primary residence at this point. Having a steady place for your kids so you aren't forced out as a renter makes sense. But locking up your life savings costs a lot to maintain, and a property taxes seems like a waste of free cash flow. Well, I think it depends. I think it depends of the person. Um, I can tell you this. Let's say I've got $10 million. Why would I go rent a house? Why don't I just buy it if I really like it? Why deal with someone who says you can live here or you're going to have to move out at a whim? I just don't like operating like that. When I was a renter, I had to move pretty quickly out of two places, and it was a complete pain in the butt. I did not like it. It put a sense of worry in me that I didn't want to have ever again. And if you have kids, and if you have a larger family, let's say, not just having one kid, but what if you have multiple kids? Um, do you really want to start to yank people out of school systems? Do you really want to yank people and move everything to another house? That's a total pain in the butt. I don't like moving. I hate moving. So I understand that it might not make a financial argument for someone who doesn't have a house to like freshly buy a house and have a higher mortgage rate and all that other stuff. But where I'm sitting, and when I purchased, obviously I didn't purchase at the low of the lows in 2011, 2012. I purchased it some years after that. I refinanced at a really low rate, and yes, I have a really, really low mortgage. I also have really low property taxes. So would I exchange that for extra cash flow? I wouldn't, because the peace of mind that I get that I don't have to ever move is great. And even if I did move, maybe I'd keep this house and go buy another one. And it may not make financial sense to do it, but I will say this: once you hit a certain amount of money, what else are you going to spend it on? Are you going to save it and just have a bunch of money and a bunch of free cash flow forever? I mean, what if your free cash flow is $500,000 a year? Are you just going to not do anything with it? What are you going to do with it? And what if you are someone who doesn't they don't need a lot of things? What if you don't need an expensive car? What if you don't need to eat expensive food? What if you just eat organic stuff that is very little in terms of percentage of your income? What if you don't like traveling? What if you don't like 24-hour plane rides? And don't get me wrong, I hate that stuff. Um, if you look at all this, it's like, well, what else are you going to do? Where else are you going to put that money when you hit a certain point? Now, if you don't have the money, then yeah, it's not an option. But there's a lot of things that might not look like financial sense that people should do to gain the experience or to gain the memory or whatever it is. Um, and you should do it, or for the peace of mind. I think when you have kids, or when you have a larger family and you've got a lot of crap that you got to move, I don't want to rent. That just sounds like total pain in the butt. But that's me. Three coming back to back. They're talking about these big deficit withdrawals in natural gas, which could be greater than 2 cubic feet, and they're talking about a weak draw. So it's never happened before. Recency bias is going to destroy people. Is in the driver's seat now. $10 plus natural gas could be on the horizon. Production cannot be ramped up like some believe. And that's the problem with nat gas. And this is going to catch everyone off guard, guys. And if we get the entire world to do this, I don't even know where the price could end up. Because what if we have a problem in the United States and we have a problem in Europe where they eat through their inventories? And then all of a sudden, there's basically, you got to price out people from heating their house. I mean, this could get real ugly. The single most important thing in the stock market is to know what you own. I made 10 to 15 times my money in Dunkin' Donuts. Those are the kind of stocks that I can understand. If you don't understand it, it doesn't work, says Peter Lynch. That makes sense. A couple more quotes. If the job has been correctly done when a stock is purchased, the time to sell it is almost never, says Phil Fisher. Warren says, to sell something that is really wonderful business because the price looks a little high or something like that is almost always a mistake. So their time frames are forever. And if you've done your work up front and you find a great company, you get a really good entry price, you should keep it forever so long that the company can't be, it's not a cyclical company. It's a company that makes something or provides a service. So when you look at these guys like Warren Buffett and a lot of their holdings, they do like insurance, food, beverage, um, banking, stuff that doesn't really change. That's where they kind of focus a lot of their money. They're not in technology necessarily. They might have a couple technology stocks, but they're not, the bulk of their money's not in technology. It's in like Coca-Cola and other boring companies. Christine Guerrero says, I learned about Daman number 7 today. It's the seventh well that they drilled. I think it's in Guar, but this single well produced over 32.4 million barrels of oil before it was shut in, and the wellhead put on display in Saudi Aramco's headquarters. The spare capacity isn't real, folks. Can't comprehend the reservoirs. So, yeah, that's what's going on there. And that's all I've got for today, guys. So I'm going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We do have a Sunday question and answer session coming up, which is today, 5 p.m. Mountain Time. And we'll see you guys there with whatever questions. All right, guys. We'll catch you next time. This is Finding Value.